Okay, so today we're tackling a huge question, one that's on pretty much every founder's mind right now. In an economy that feels like a roller coaster, how do you build a brand that doesn't just, survive, but actually get stronger from all the chaos? We're going to break down a really powerful playbook, and we'll use the incredible story of Bangladeshi startups as our main case study. All right, let's jump in.
I wanted to start with this quote because, wow, it just gets right to the point, doesn't it? When things get tough, is your brand a living, breathing thing that people actually connect with? Or is it just a bunch of numbers on a spreadsheet waiting to dip into the red? That's really the core challenge we're going to unpack here.
So just how tough are we talking? Well, let's look at the numbers. First hit. In 2024, local startup investment in Bangladesh just fell off a cliff. It dropped by a staggering 95%. Imagine that. The VC money that everyone was counting on, suddenly, it was gone.
And then came the second hit. At the exact same time, inflation shot up to over 10%. Now, that's not just some abstract number. That's a direct punch to your customer's wallet. Every single dollar, every taka is being counted. People's spending habits were changing literally overnight. And here's the final blow that creates this perfect storm. Total funding for the entire ecosystem hit a 6-year low of just $41 million. That's not a slowdown. That's what people started calling a full-blown startup winter. So when you put all three of those pressures together, what do you get? You get what the source material calls a classic pincer move. Think about it. On one side, your own costs to run the business are soaring. But on the other side, your customers have less and less money to spend. And the startups? They're trapped right in the middle of that squeeze. But look, this isn't a story about doom and gloom. It's about a really powerful shift in mindset. It's about moving past just playing defense, just trying to survive, and adopting a much more offensive strategy. It's about this idea of becoming anti-fragile. We hear the word resilience thrown around all the time. The idea is you're like a rubber band. You get stretched by a shock, but you snap back to your original shape. That's fine, but it's not enough. Anti-fragility is something else entirely. It's about a system that doesn't just withstand stress. It actually uses the chaos, the pressure, as fuel to get even stronger than before. And this table really shows you what that looks like in the real world. A survivor plays defense. They react by slashing prices and cutting all their marketing. But a thriver, an anti-fragile brand, they go on offense. They innovate with things like value packs. They reallocate their marketing spend to channels that build loyalty. And instead of just being lean and rigid, they embrace this idea of bricolage, which is basically a fancy word for getting creative and innovating with whatever you've got on hand. It's a completely different, much more adaptive response. Okay, so how do you actually do this? This isn't just about some vague philosophy. It's about a disciplined, practical playbook. So let's break down the 5 concrete steps any startup can take to go from just surviving to thriving. Here it is. This is the roadmap. It all starts with being absolutely obsessed with your unit economics. Then it's about building real trust with authentic voices and totally shifting your messaging to prove your value. And finally, you have to make your product affordable and you have to solve real physical problems. Let's dig into each one. Step 1, forget the vanity metrics. Total number of users, app downloads. Honestly, who cares? The only number that really matters now is whether you're making money on each and every transaction. The example here is just perfect. This food tech startup made the really tough decision to shrink its delivery area. And the result? Profit per order jumped 12%. They stopped burning cash they simply didn't have anymore. Step 2 is all about one thing: trust. When times are tough, nobody trusts a slick, polished corporate ad. They trust people who look and sound like them. The source material points out that localized Bengali content gets 3 times higher engagement. And this skincare brand proved it. They used 50 local micro-influencers and got a 15% higher conversion rate than they did with one huge celebrity. It's real, it's authentic, and it just plain works. All right, step 3, you have to change how you talk to your customers. When people are worried about their finances, brand love doesn't pay the bills. You have to prove your utility. Take Chaldal, a grocery delivery company. In the middle of crazy inflation, they launched a price lock feature. Now, this wasn't just some clever marketing slogan. It was a direct solution to their customers' biggest anxiety, and that built a ton of trust and loyalty. Next up, step 4 is all about making things accessible. If your customers can't afford to buy your product up front, you have to find a way for them to pay for it over time.
Tools like Buy Now, Pay Later or simple installment plans are no longer just a nice little feature. For bigger ticket items, they are absolutely essential to actually making the sale when cash is tight. And this final step, step 5, might just be the most important one of all. Don't just go build another slick app. Solve a real, tangible, infrastructure-level problem. ShopUp is the perfect example. They didn't just create another e-commerce website. No, they built the entire underlying system to fix the broken supply chain for hundreds of thousands of little neighborhood shops. They solved a fundamental, real-world problem. Okay, so that's the theory, right? That's the 5-step playbook. But the big question is, does this stuff actually work in the real world? Well, let's look at the proof, because the results here are pretty incredible. This right here is a masterclass in being anti-fragile. Smack in the middle of that startup winter, ShopUp did the exact opposite of what you'd expect. They didn't retreat. They went on the attack. They merged with Sari, a big player in the Gulf region. By creating this new entity, Silic Group, they connected regional supply chains, they reduced their risk from any one single market, and, get this, they cut procurement costs for the retailers by 40%. They literally used the crisis to build a stronger, cross-continental giant. And hey, this isn't some new idea that only works in Bangladesh. Just think back to Lego's famous turnaround story in 2003. The company was nearly $800 million in debt. How did they pull themselves back from the brink? Not by launching more new toys. They did it by cutting 30% of their product lines and focusing ruthlessly on their core customers, the 20% of fans who drove 80% of their revenue. The lesson is timeless. In a crisis, you have to protect your core. Focusing on your core is a powerful way to survive, but it's really easy to just celebrate these amazing success stories and call it a day. The source material pushes us to take a more critical look. What's the hidden cost of this kind of high-stakes, pivot-or-die environment? There's something we need to talk about called the resilience tax. First, there's the human cost. The constant, intense pressure leads to massive founder burnout. We're losing incredibly talented people. At the same time, you've got new regulations that, while they might be well-intentioned, create huge financial hurdles that smaller, innovative startups just can't clear. So you have to step back and ask, is this survival of the fittest world accidentally creating an ecosystem where only the biggest, best-funded giants can even play the game? And that really brings us to our final and maybe most important question. As we celebrate the amazing strategies of these companies that thrive on chaos, we also have to ask ourselves, what kind of ecosystem are we building for the future? Is there a way to encourage this kind of resilience that supports not just the current giants, but also the next generation of innovators who are just getting started? It's a really critical question for everyone, founders, investors, and policymakers, to be thinking about right now. Thanks for joining me for this deep dive.